All right. I am not a financial planner and I am not a broker. So I just want to start off with that. I am just giving some little tidbits of what I do. So I got a question on how do I choose my stock picks? So I am no super duper big old guru that knows everything. And that's why I think everyone can relate to me. I do the bare minimum, when looking at stocks. And there's so many more things you can look at, and there's so many more deep dives you can go into looking at the stock market. But I realized that the stock market is pretty much at the whim of the people. Most of the stocks are technically overpriced because the people just, that's how they feel. Now, you do need to consider that in the future, the people might turn against the market and it could go down. And you should have the company's finances to back up your stock purchases. But right now, I don't deal with all that because it's just like oh, I guess I do because I always make sure that the company's not going to go broke in the next 2 years, and I follow the news on the company. But let's take, for example, Apple. Apple's considered overpriced, yet it's still trading and it's trading up. It's not going to trade down. I mean, they're sitting on $1 trillion of cash, and they have so much potential to invest and change and grow that I don't foresee them going anywhere anytime soon. So Apple itself is a great example, and I've been using that example before of a company you can choose to purchase in. But if you want to get a little bit more speculative of which one you should I buy Apple over Microsoft? That's your option. I am telling you guys to stick with blue chips, but in some cases, you might want to throw $5 or $10 on the next Apple as opposed to buying Apple. And I totally understand that because they are out there and I am buying them. So if you want to know exactly what you're getting into, first off, if you don't understand everything, that is a-okay, and you can just go ahead and buy Apple because Apple's going to go up eventually. Now, if you want to understand a little bit more and buy some smaller stocks, you can. When I'm looking to invest in a new company, I go to my Robinhood app first and I peruse their popular lists. Now, they have different categories you can choose from. Let's say you're really in the mood to invest in a bank, you're really in the mood to invest in agriculture. They already have it listed up here in different categories for you. So, whatever you have a hankering for that day, you just go ahead and click on that. Now, they have individual stocks that you can find. You have ETFs, you have indexes, and I believe I spoke before about what an ETF is. If not, an ETF is an exchange traded fund that is put together by a brokerage firm. And let's say this brokerage firm is like, I want to create a group of companies that have a similar theme, such as all the electrical companies in the United States that have public offerings, we're going to put them into one ETF. So if you have a hankering to invest in um, an electrical company, but you don't know which one, you can always just buy an ETF, just like you would buy a stock. And basically, they're all in the same little bubble. And that's an ETF. Now, an index fund tends to be over the entire market. So let's say every like the S&P 500 or whatever, it's over 500 companies that are at the top of the market, and that's what you're buying. So that's the difference between the two in my mind. Who knows? All right. So I tend to stay away from ETFs. Well, no, I own a couple ETFs in my Schwab account. See, so it's separate from my Robinhood because I don't want to have that want to trade in and out of it. So Schwab charges you a commission fee, and I think of it like, when you're shopping on Amazon and you get to the cart part and you find out you got to pay $5 for shipping, so you'll put the item back. Even though it's still cheaper, you just have that mental process where you're just like, "Hey, you're gonna charge me shipping? Oh, well, I'm not buying this." So that's how I feel about Schwab. Like when you purchase and sell on Schwab, you have to pay a fee. And if you have to pay a fee, you'll be less likely to jump in and out of trades. So when I buy on Schwab, it normally just stays on Schwab. I don't mess with it. I'm not in and out. Now when I'm on Robinhood, I'm in and out because it doesn't charge you a fee, and it's just so easy to try to time the market, which is not what you want to do. And but I do it anyway, just because I find it fun. It's more of a pastime as opposed to um, a strict investment policy. So you should buy and hold. But if you want to have fun like me, this is what I do. So when you're ready to invest in something, we'll take banking, for instance. I'm not currently invested in a bank, but that's okay. I can just run through if I were to buy something or if I was not to buy something. So the first thing I do is I look at what my ideal price range would be for something. And I think I want to stay under $30 per share. Now, this is arbitrary because you can purchase fractional shares, right? So a fractional share means like if one share of Apple is $132, but I only got $10, I can still buy a part of that share. So I would get money based upon whatever the fraction of the share is. If I bought 1/5 of the Apple stock, I would gain money on 1/5 of an Apple stock. So if the Apple stock went up to $300, I would get 1/5 of that value, just to give you an idea. That is why I say you don't have to have $1 million to start. Just throw $5 on it. $5 will become $6. Throw another $5. That means you have $10 in there. That means $10 becomes $12. Think of it. In the future, your money will snowball. You can reinvest. You can buy more shares. You'll have more money. So that's why it's never too early or late to start. Just get in there when you can. So we're looking at these here banking offerings. And I did mention in our group that Visa looks like it's going to be a mover. All right. But you can't hold Visa and MasterCard, they're not going anywhere. They're just going to be making more money and more money and more money, right? So Visa right now is at 215. And I think I mentioned it like a week ago or something like that. Uh, don't know. Yeah, when it was down to like 212. Yeah. So I mentioned it when it was down to 12 in the group. Hopefully, maybe some of you guys got in there. If so, you're up to 215 and it's just going to keep going higher. Now, as you can see, the second thing you want to check after you click on a group is what's going on inside. And right here, it tells you who's in the group or who's in the company and when the company was founded and the dividend yield. This is important because if you're purchasing something, you either want to make sure it's going to be a really good growing stock. Like if you're buying it at 215, you want to make sure it's going to be like like $300 within like a year or two. That would be a growth stock. You wouldn't want to buy a stock which is going to stay at 215 because your money is just going to be stagnant. It's like gaining no interest if you're always at 215 and it's not paying a dividend. Now, if it's always at 215 and it's paying a dividend, you're growing still, even without the growth, because every quarter they're going to pay you a little bit of money just for owning the stock. And you could take that money, reinvest it into the stock, which means your stock, instead of having that one share, you'll have that 1.5 shares. And over 10 years, if every quarter you're getting paid a dividend, you'll end up with 100 shares in the end, which means technically your money did grow because you have at the end, you can sell it all and you'll be more richer than if you were in the beginning. So the second thing we checked was that there's a dividend yield, and there is. That is great. It is 0.56. That is an annual dividend yield, annual, yearly. Keep that in mind because you don't want to be like, oh, it's paying 0.56 and that's just awesome. In my opinion, that's not awesome for a dividend, but this stock also has growth potential. So it's a nice split that I can own it. Not only will I be gaining the dividend, but I'll also be gaining the growth. So let's keep scrolling down. So Robinhood offers this a wonderful tool here where they have analysts, see 36 ratings, 36 people rated this, and they're rating it a buy. Why are they rating it a buy? Like I said, Visa ain't going nowhere, and it's just going to go up. MasterCard is another one of those that ain't going nowhere, and it's just going to go up. They're at like $344 a share. 2 years ago, I bought it at, I believe it was like $180 a share. So it's just going to continue to go up. They're not going anywhere. The world runs on Visa and MasterCard. Visa is a little bit cheaper than MasterCard right now, and Visa grows a little bit slower. But the thing is, it you can own more shares because it's cheaper. And that's why I chose Visa over MasterCard. They're going to grow probably about that same rate. So why not get two shares as opposed to one? That was my logic. Okay. So this is the second thing, as I said, we want to look at the buy. If your buy is over 50% for Robinhood, I tend to, be like, okay, I can do this. This is a good stock. I might be able to get in there. If the buy is over 50%, that's just one of the parameters you want to meet though. The hold is at 17% and the sell is at 3%. So no one's telling you to sell right now. They don't foresee it going bankrupt in the near future, which is great. So if you want to buy in, this is why the second reason why I was like, Visa doesn't seem that bad. So the third thing you want to look at is this little dilly here, the earnings report. So 4 times a year, every company comes out with the earning report, right? And before that earning report comes out, they give you the estimated what they expect to make in that time frame, and then they give you the actual. Once that actual hits, the stock normally goes up or down based upon whatever it comes out or whatever the sentimental feelings are about it. But you want to watch the last 3 quarters. So for Visa, the last 3 quarters, as you can see here, you'll see a faint green dot and a light green dot. If you see a faint green dot, if you see the faint green dot above the light green dot, that means they missed their projection. I'll bring up an image of that later on to show you what it looks like. But you want to make sure whatever the actual is has been met. If they've been meeting their actual, that means the company's not lying, and you don't want to invest in a company that's lying. Or over projecting. They might not be lying, but they might be over projecting, because what's going to happen is when the actual comes out and it's below the expected, the company's going to tank. And if they've had like a 3-quarter trend of this, you don't want to touch it with a 10-foot pole. Okay. And well, that's my opinion. I mean, some people be like, oh, well, next quarter they're going to do good. But you want to try to stick with the trend, because you can't fault yourself in the future if you go with the trend as opposed to against the trend. But like, oh, going against the trend is speculation, right? So next thing we want to do is, let's go down here. After we've reviewed all that, say, okay, well, I could definitely see this being something I want to invest in. What I do next is I go to Yahoo Finance. Let's get there. I go to Yahoo Finance and then I put it in. These are all free things you can use without having to invest in. So Yahoo Finance gives you the best free stuff, right? So when we looked at Visa, we see it's at 215.51. It's stating here that the company is estimated in 1 year they'll be at $231.94 a share. So are we making a profit there? Yes, we are. So I always take to heart these numbers. When I first started like 5 years ago or whatever, I was like, no, that's not true. They'll never meet those numbers. And guess what? They met the numbers. And I'm like, oh, okay. Well, if that's the truth, then that takes out a little bit of the doubt that I have when I invest into a company, because they're already estimated what they're going to be in a year. And most of the time they actually exceed that number. It's higher in the end. So um I always, try to check that out because it's a free information from Yahoo. The next thing you want to look at is the 52-week range. So the 52-week range, which is listed right here, this is amazing. So let's say within the 52 weeks, the company dropped down to $133.94. And I didn't buy. What's wrong with me? Why didn't I buy? Maybe I was sleeping at that time. But if you would have right now, you'd be back up to 215, which is great. But you see the top of it was 220.39 was the high, and we're below the high right now. So it's still, it might be a decent buy, you might make some money. It's more for sure because we know it can get back up there within the next 52 weeks, which is great. I don't like to buy at the top. I mean, some people see it going up like Tesla. If I would have bought Tesla at the top, we'd be at $800 or something like now. But I don't like to buy at the top on a company that isn't offering a dividend at the very least, because you might have to hold this stock if the market drops. If the market drops, you're gonna have to hold it. And I don't like holding a stock that has no dividend um, potential while I'm waiting for it to come back up, because that'd just be a wasted year. All right. Pay attention to when dividends are going to be paid. Typically, the stock goes down when a dividend's paid. And you never want to buy right before dividends are being paid. So you would just always make sure that you don't buy right before dividends. If you do want to purchase a stock, try purchasing it right after the ex-dividend date if you want to wait for that. Sometimes it works, sometimes it doesn't, but I would never buy right before the dividend is being paid. Okay. The next thing you would like to do is to make sure you check the chart. We want a chart that is moving up. I know this might sound counterintuitive, right? No, just kidding. I know this might sound pretty self-explanatory, but we want an upward trending stock, because if I bought it on April 22nd, 2016, I would have bought it for $79. And if I still owned it today, we'd be at like 215, right? We always want trending up. So I always check 3 charts. We want to check the month, how it's been moving for the month, 3 months. No, the month, the year, and the 5-year. Why do I do that? We just had a pandemic. So I know that we're coming back. And I've been really using this year chart because this is doable. To the before the pandemic, February 19th is doable. And when that money dropped all the way down to $135 for Visa, yeah, I didn't buy it. It's okay. We know that we're only going to move up from there because this was due to an event, and we're only going to trend up from there. But we also want to verify that 5 years ago we were doing better, right? As we move forward. So we are doing better, better, better. Oh, if this event didn't happen, it would be up here. We would definitely be up here. So purchasing down here, I know that within the next 5 years, we're going to be up here again. So it is a great buy. So you always want to view the charts. So let's take another, for example, Apple, the 5-year chart. Bloop, 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 bloop. The 1-year chart, pandemic right here, but yet we're continue our growth. Okay, and then the 1-month chart, yep, it's going up. We're down for the month, so it might get back up to 136 by next month. And that's exactly what I do. So I love my charts. These are the free charts. You can always go and get the more, or you can go get the more complicated charts, but you really don't need it if you're just starting out. Now, I'm going to show you something that's not blue chip that I chose due to those parameters, right? That would be NLY. NLY was something I picked randomly out of one of the charts that offered for real estate on Robinhood. So I went through the real estate charts and I was like, let's take a look at their charts here. Oh, well, they are down for the month, which means I can get back up to 156 was my first assumption. Secondly, pre-pandemic, we were at 1041. Pandemic dropped us down to 456, and it's doing its upward trend. Was my second. Then I did the 5-year charts. And this company is not a growth stock. This is why it's pretty steady. It's up and down within this basic trend here. So this would be a sideways moving company. So we want to be between $9 and $10 is basically where they're at in their sideways movement. But this company offers a 10.98 dividend, and that is why I bought it. I was like, that'll be some great return there on this, even though it's a sideways mover. And I do trade options. So I sell options on my company that I own. We'll get that into that in the future. But as you can see, this has a 64% buy. And so that's above our 50% threshold. And it has a 36% hold. So even if um, the market went down, people still want to hold it because of this dividend, right? There's no one telling you to sell this stock at this time. And here is the earnings chart that I was telling you about earlier. So the company put out an estimate here, right, of a little bit above 21 cents, but the actual was about 32 cents, right? So this company is trending up, which is great. And that's what we want. We want to trend up. We want to have over 50% on the buy ratings. We also want to have a dividend. We also want to, check and see our charts to make sure that the dip was due to something other than financial strife, right? This wasn't due to China. This was because of pandemic. So we know that we can get back up to 1050 eventually. Maybe take 5 years, but in that 5 years, guess what I get to do? I get to claim quarterly dividends from this company for owning their stock. Why wouldn't I want to buy this one, right? Even if it did drop down. See, right now it is dropped. It dropped 2.25% because I bought it at 8.45. But my projection is it's going to be at least $9, right? So when is it going to hit $9? Who knows? But I know it's going to hit $9 eventually. In the meantime, I get to collect in the interest. And that's how you gotta think about when you do your purchases. Why you buy, how much you're buying for, what the company's doing, and what's going on. So after you purchase, you might want to, also watch what the company's going to do in the future and things like that. See, like I'm selling a call on it for $7. Oh no, I have a buy on it. Sorry. I'm buying a call on it for $7 because then if I can, I definitely want to make more money. So if it goes up to let's say the 850 I'm looking for, I'd make money on the calls. I'm selling calls, so I'm making money in the process, but that's in the future for you guys. It's not right now. But that's my evaluation of this company, and that's why I bought it because I really wanted the dividends. Second one I did was NIO. NIO, it's got so much social buzz that I looked into it. I'm like, I'll do a little buy on it. I was gonna do an option on it, but the options are so expensive. I'm like, okay, well, if everyone expects it to be $100 by the end of the year, buying 5 shares is gonna kill the bank. So I bought 5 shares, and if it goes up to $100, that means I'm double my money pretty much. So I can deal with that. I can live with that. So on this one, they don't pay a dividend. This is purely speculative that this is going to happen, but it has an above 50% rating, and they are exceeding their expectations, and that's what we're looking for, right? So I did a little market buy of $300 on it because I didn't want to miss the wave if it came, but if it doesn't, I'd lose $300. I think I can live with that. But so far, I bought it at $53.71, and it's up to $59 or something like that now, which gave me a total return of $29.88 so far. And if it goes as projected to $100 a share, you know, that's nice. If not, oh well. But that's what happens when you get into when you start to do the speculation portion of purchasing. The other one that I purchased was Glow Club Capital for 14.15. And as you can see, they had a dip because of pandemic, but they were at $18.41. I'm like, let's get back there, my fam. Let's get back to $18.41 because then we'll be sitting pretty. So I sat here and purchased, looks like 1,050. And I'm also doing reoccurring purchases because I want that 1850 is where I want to be back at. But in the meantime, this company pays at 8.32 dividend yield, and they have met their expectations on their earning reports. So I felt it was strong and that they'll get back to where they were. So I bought back in. The last company I speculated on is this one. So it dips off every day, every after hours, every time. But I bought it for 508 and it's worth 534 now. So I have a $51.18 return so far. It pays a 0.89, but basically it's a Brazilian steel manufacturer. It had over the 50%, and it met its expectations. So as you can see, this is what it was estimated at, but it's like, whoop, no, we're going to do way better than that. That's what it said. So they don't over promise and underperform. They under promise and overperform the last looks like 5 quarters. And they even like estimated a negative 4 cent return because they won't lie, which is great. And that's what I want. I want a company that's going to tell me the truth, even if it's going to hurt, because it's hurt by projecting that. That hurt, but they exceeded the expectations. So I'm thinking it's going to make it up to $6 a share. Let's the 5-year chart. Let's see. They've been growing steadily, growing steadily. So I think they're going to make it. But if not, I'll take my little 50 bucks and run. And that's how you got to think about it. So hopefully this helps you in choosing. Now, oh, I guess I need to show you guys how to actually buy. Okay, so let's say you would like to buy, we'll just pick a random one. I've been thinking about buying, someone suggested Plug, and it's got it going on, doesn't it? So, oh, it missed one of my parameters, but I'll buy it just for you guys, just to show you guys. So on this side of the screen, let me move myself out of the way. So you'll click on the item and then you'll invest. You can invest in dollars or shares. So this means how much money you want to put in, or if you know how many shares you want to buy. I always select dollars because we're buying fractional shares for the most part, right? And then you'll select the amount you'd like to invest. We'll just do 500 bucks. Now you'll review your order. You are placing a good for a day market order. That means that you're going to place this order for a day, and if no one sells you any stock, because it doesn't come out of thin air, someone sells you the stock, so you buy the stock. If no one sells you the stock within one day, it'll cancel the order and you have to place it again. There is another option where you can place an order that's good until canceled. So it'll just be good until for weeks and weeks or months, depending on if you want to cancel it. But as novices, we'll just start with this. Now, if you place this order for 500 bucks, it's going to yield you 9.398 shares of the company. Okay, at the current market price, which is $53.20 for Plug. All right. So if we go ahead and buy, blam, you own it. Okay. Now, the other option is if you click on the little drop down, we have something called a limit order. Now, a limit order is basically telling you the person, hey, I'm willing to buy it for $50 a share. Are you willing to sell it to me for $50 a share? And a limit order will basically stay pending until you find someone out there that's willing to sell you the stock for $50 a share. Now, let's say the price of plug goes up to $55 a share. You'll never find anybody out there who's willing to sell to you for $50 a share. So that limit order could stay open, pending, and you could miss the boat. So just be aware of that. I, for the most part, always do market orders. Always market orders because I don't want to wait and you might miss the boat and you might miss the upswing because you were trying to get it for cheaper. Now, if you truly believe the stock isn't worth any more than that $50, then of course, you can make your limit order. Now, what you can do is after you purchase the stock, you can sell the stock, okay? Why would you sell a stock? If you feel like some news came out, which the other day did. So let's give you an example. Let me get it. I used to own a company called AAL, which is American Airlines. Let's move me out of the way. And I owned this stock at like $16.50 a share. No, I previously purchased it for like $11 a share or something like that, and it ran up to $16 and $17 a share. And then COVID-2 happened and it started to drop. So guess what I did? I sold because there's no reason to sit in there and hang out with the drop. And it dropped down to $15.12 so far. But over the year, it can get down as low as 11 bucks. Now, if you don't want to miss the when it potentially goes back up, you can stick in there and hopefully it'll go back up. It will. American Airlines will go back up probably in like a year or two, but I mean, I don't want to sit around and wait for that because the dividend yield it's 2.64. So I sold it, and if I really, really want to get back in, I can at any time. And that's the good part about being in the stock market. I can buy in today at $5.12 if I wanted to, but I don't because I don't know what's going to happen next year. Airlines and cruise lines. I used to have a lot of stock in both, and I got out because of pandemic. And I managed to break even, thank the Lord, on my cruise line. But I only managed to do that because I was selling options against my stocks in order to bring the price down in order to sell and get out. But yeah, we'll learn about options in our next video, maybe. Maybe if you guys feel ready for that, you got to let me know. All right. Y'all have a great day.